Just as we had that phase one trade deal, then coronavirus hits the global economy. Can you tell us what kind of implications this has for demand destruction for the quantities that you're in the business of shipping to China? Have you had any requests for force majeure or flexibility in deliveries from Chinese customers so far?
Yeah, look, it's a good question. If you think about where we are, the first half of the financial year for us was a tough year on prices, but interesting enough, the last 2 months we've actually seen increases in most of our commodity prices, and I think that's part of the challenge with the coronavirus is not only the uncertainty surrounding it, but for some commodities it's actually having a positive impact in the short term. You asked a question about have we had any, refusals, letters of credit refusals or turning away of cargoes. At the moment, for the majority of our commodities, the demand is actually still strong. And in fact, there's a preference for some imported ore rather than domestic ore, particularly in manganese and also in met coal, which we see as a positive. Now, the key question for us is how long does it'll last for, and obviously what comes out the back end as China continues to come out of Chinese New Year.
Yeah, what's interesting is you're seeing that you're actually seeing short-term, optimism or managing the situation, right? How long do you expect that to last for? And then I know that you've been fairly optimistic that on the other end of this, you're going to see fiscal stimulus by the government. Do you expect to see a boost in prices then as we see an infrastructure ramp up in China?
Yeah, look, a couple of things, I guess. One is, we'll talk about China, but what we've been very focused on for the last 6 months and the next 6 months is delivering on our production guidance, which are on track for all our commodities. If you talk about unit cost performance, we continue to reduce our costs to sort of prepare ourselves for lower prices. But when it comes back to what we're seeing in the market at the moment, we sell about 22% of our product goes into China. The big exposures for us are really manganese and also met coal. And in both of those markets, we're seeing some of the restrictions around worker availability for domestic production. Transportation restrictions are really pushing people to a stronger, if you like, demand for seaborne product, which obviously suits us. Now, short to medium term, it depends on how they sort of go around in the steel industry, because both manganese ore and met coal depend very much on steel production. But again, in the second half of the calendar year, we would expect that the government would start looking at what it needs to do to catch up on GDP growth, including potentially a large fiscal stimulus.
Given the challenges that you're facing at the moment, whether it's a global macro environment or just prices falling, do you feel that you have the right portfolio mix, the right mix of commodities?
Yeah, I think the first thing to say is, do we have the right balance sheet? And I think we have an incredibly strong balance sheet. So even in a world of depressed commodity prices, we increased our capital management program by $180 million, which takes it to $1.43 billion. And that reflects our strong balance sheet, but also our positive outlook on the business. If you talk about the commodity group itself, we are in that position of transitioning our portfolio. We're actually exiting our South African energy coal business. We're doing a review on 2 of our alloy smelters. And at the same time, we're brought in a variety of new development options, such as Samosa, Ambler Metals, which have much more of a bias towards base metals. So we continue to evolve our portfolio for the future.
Yeah, you mentioned the exit on your coal business, and of course we continue to see pressure on that front, climate change related pressure. Some have said that perhaps metallurgical coal could be the next target. Is this something that you're concerned about?
Look, we've started from day one that we believe, climate change is real. We've said from day one that we wouldn't build, buy or operate a new thermal coal business because we do believe there are substitutes out there. It doesn't mean the whole world is going to transition exactly the same way. So more developing countries like South Africa, India, Morocco, they've got a different growth trajectory in how they transform away from the carbon footprint. So there are substitutes, though, in energy coal. But in met coal today, I think the bigger challenge is there are no viable substitutes. The key is for met coal is to continue to produce high-quality coking coals like we do at Illawarra, and also continue to look at ways to actually reduce the carbon footprint through new technologies that can be used.
The export of coal to China has really been the biggest kind of source of criticism when it comes to Australia's energy policy, with public opinion and discourse really centred on climate change, particularly after this bushfire season that we've had. Is it a bit of a PR nightmare to continue pushing a development like Eagle Downs?
Yeah, so again, Eagle Downs is a hard coking coal, so it's not used in the generation of energy. It's actually used in the creation of steel, and today there is no substitution. The advantage it does have, like our Illawarra existing mine today, is it's high quality coking coal. So obviously it has a smaller carbon footprint, and I think that's something the world has to continue to work with until there is actually an alternative that's cost effective.
In terms of exiting low-returning businesses, which I know you mentioned in today's presentation, what does this look like? Because I know there's been the sale of the energy coal unit in South Africa. What else would you be looking at an exit for?
So the big one for us is our South Africa energy coal business, and that remains on track to be completed by the end of this calendar year. The other two that we're looking at the moment is our manganese alloy smelter business, one in South Africa and one in Tasmania. And we're exploring options on there ranging from closing while prices are low, closing permanently, and also looking at a different ownership structure where someone else sees more value in it than we do. Both of those processes I expect to continue and come close to completion by the end of our financial year, which is June.
What about new projects? You formed the Ambler Metals joint venture in Alaska. How much of an exposure will this give you to copper and other base metals?
Yeah, we've had a very clear strategy from day one about getting more exposure to new development opportunities because the cupboard was bare when we started as an organisation in 2015. We've added Hermosa, which is lead, silver and zinc, plus the exploration property there has a lot of prospectivity for copper. And we formed the joint venture with Trilogy for Ambler, which completed yesterday, which gives us a 50% interest in essentially two projects, one being Arctic, which is a copper deposit, and some polymetallic materials as well, and also Bornite, which is a large copper deposit and a very big, large land position. So while they're early stage exploration development projects, they certainly give us the opportunity to have much more of a bias towards base metals, and in particular to get more copper exposure.